I'm Grant Walker. Welcome to Heads Up for Monday, the 11th of May. I'll be back with Last Call for you today at 4. To the Auckland Transport Plan and politics. Simon Bridges does not have confidence in Auckland Council's transport plan, saying the city needs more less iconic big projects and more smaller scale projects that actually deal with congestion. For the first time, the Transport Minister has given examples of what he wants from Auckland's plan. On TV3's The Nation, he suggested axing a plan for rail to the airport and increasing funding for local roads. His comments came in the same week that the council voted for a new $114 a year transport levy on rates. Mr Bridges says he wants the city to wait for new spending until the government and council can reach alignment. He urged the council to focus more on getting good roads, but also said we're not prepared to give those funding tools until we see a strategy that deals with congestion and more effective public transport for Auckland for the next 20 to 30 years. If those roads aren't built, he said, we think that it slows down the ability to have greenfields development and more special housing. He described comments by Deputy Mayor Penny Hulse on stopping special housing area developments where there isn't infrastructure as leveraging, because the council knows it's so important to the government to see more housing in Auckland. Mr Bridges insisted National is doing a huge amount in Auckland and that nothing he was saying undercuts the government's commitment to making the Auckland super city master of its own destiny. Mr Bridges stuck to claims that Auckland Council plans to spend less on transport compared with the past 3 years, although Auckland Council told the nation that isn't correct. He denied his government is waiting for Len Brown on the council to be voted out next year. He said, what I've been offering, and I know the Mayor is very keen on this, is the option to actually explore formal agreement. In politics, the Property Council claims a government U-turn on earthquake strengthening is a massive victory. However, it's not a view shared by all its members or survivors of Canterbury's earthquakes. Building and Housing Minister Dr Nick Smith has reduced the number of buildings requiring assessment from an estimated 500,000 to 30,000. Owners will also have more time to carry out strengthening in many areas. Wellington investor Ian Castle says property owners should just be told to get on with it as quickly as possible. A survivor of one of the Christchurch earthquakes, Anne Brower, says the moves are disappointing. She was the only survivor when masonry fell on a bus in the central city. But Property Council Chief Executive Connell Townsend says businesses can't afford the extremely high costs associated with strengthening. Lobby group Business New Zealand has also welcomed the rule changes. According to Business NZ Chief Executive Phil O'Reilly, moving from a one-size-fits-all approach to a risk-based approach is sensible. He said while all commercial building owners will wish to ensure their building safety and stability, this is best achieved with regard to the actual earthquake risk in differing areas. To the courts, two groups in a profession usually concerned with numbers have ended up in court over words. A naming stoush between two accounting groups has gone to the High Court over evidence. The Chartered Institute of Management Accountants, CIMA, wants a trademark for its name, but this was opposed by the Chartered Accountants Australia and New Zealand, or CAANZ, which was earlier known as the New Zealand Institute of Chartered Accountants, or NZICA, pre-merger with its Australian counterpart. CAANZ has said using the trademark would imply membership and would be contrary to specific accounting legislation. Although the case had been progressing through the Trademarks Tribunal, Cairns went to the High Court after the Assistant Commissioner of Trademarks, Natasha Ali, decided Cairns' former General Counsel Richard Moon should be cross-examined. Mr Moon no longer works for Cairns and was made redundant during the merger. The lawyer had claimed he could not locate a strategic alliance agreement made between the two parties. He then refused to release the document on the grounds that it was not relevant to the proceedings. According to the decision, the agreement refers to the parties agreeing that cooperation might enhance and add values to each other's intellectual property in areas of academic, technical and commercial expertise. Cairns claimed that cross-examination was not needed, but should be viewed as being pursued for a collateral purpose, namely being primarily to attack Mr Moon's credibility generally. The decision says the fact is that cross-examination will only occur when, in applying the overarching principle, the Commissioner is persuaded that she or he will be materially assisted in the task of reaching a substantive decision. Henry Hughes principal Elena Zentevani, who acted for CIMA, says NZICA can still appeal the decision. However, if this does not happen, the IPONS Commissioner will cross-examine Mr Moon.
NBR Radio. With the Property Press. It's out now to show you around.
To the superannuation fund, Finance Minister Bill English plans to amend legislation that lets the New Zealand Superannuation Fund streamline its investment structure to prevent politicians from interfering with its management, dropping recommendations drafted by a select committee. The New Zealand Superannuation and Retirement Income Amendment Bill passed its second reading last week, though Mr English told the House he plans to introduce a supplementary order paper that would drop the need for ministerial approval over investment decisions. The main feature of the bill lets the guardians of New Zealand superannuation control fund investment vehicles, or FIVs, holding companies the fund would use to invest in other entities' funds and assets. Mr English plans to drop a clause inserted by the Finance and Expenditure Select Committee's report on the bill that would have required ministerial sign-off on the use of FIVs to ensure the fund's investments were passive, saying politicians interfering to the fund's management was the biggest risk to the taxpayer. Mr English said in his speech introducing the second reading, it's not consistent with the Guardian's independence as originally set up by Dr Cullen in a very thorough manner and supported, I think, by most of the Parliament at the time. That independence means that the Minister of Finance should not be approving investments or classes of investments. The super fund was set up by then Labour Finance Minister Michael Cullen to help pre-fund the pension bill of the baby boomer generation and has grown to $28.97 billion under management. Mr English said he was comfortable that existing controls would ensure the fund doesn't go beyond its mandate. He said if this fund were to show that it could not find that balance remaining independent, then I'm sure the government would want to see legislative action taken. The fund estimates the cost of not being able to control passive investment vehicles to be about $50 million through foregone opportunities, taking on more risk and the result of higher fees, though the Treasury's advice to the Select Committee didn't view savings as the primary driver for the legislation. Labour Party finance spokesman Grant Robertson said his party supported the legislation and the independence of the fund's manager, though he said it would be completely possible for a future government to change the parameters of its mandate. The Green Party opposed the legislation, with co-leader aspirant James Shaw saying they hold a deep concern that the type of vehicles that are being authorised by this bill will enable the use of tax havens. Other concerns were raised about excluding the FIVs from the Official Information and Ombudsman Acts, though they were allayed by the fund being subject to information requests. In People News, MediaWorks Communications head Rachel Lorimer is leaving the company on June 19 to take up the role of Head of Communications at St John. She told NBR Radio, I'll be sad to leave, but I'm looking forward to the new role. I have had a good run at MediaWorks, and the role with St John is an exciting new career change and a positive career move. Her departure follows 2/3 of the senior executive team leaving late last year. She has no immediate replacement and has been with the company for 4 years. Her departure comes as the TV, radio and digital media company is never far from the headlines. Recent hot topics include its preparation for sale, the Campbell Live review and controversies surrounding its reality TV shows. Media coverage of the company has increased significantly since the appointment of former NZX boss Mark Weldon. He, along with senior executives and board members, have an incentive to sell the company. LA-based private equity firm Oaktree recently increased its shareholding to 77.8%. The company posted an after-tax net profit of $11.9 million for the 10 months and 22 days to September 30 following the company's restructure, which saw senior lenders convert their debt to equity in the new entity. The previous result was a $90 million loss. In business news, ManaBus.com, the recently launched online budget bus company owned by Scottish transport entrepreneur Brian Sota, will acquire rival Naked Bus for an undisclosed sum. The Wellington-based bus service said the acquisition will add South Island routes to ManaBus.com's service and expand Sota's transport operations across the country. ManaBus.com launched last October, offering long-distance, low-cost bus services on tourist routes through the North Island. ManaBus.com is part of the Scottish transport entrepreneurs Salter Holdings New Zealand transport portfolio, which includes Auckland urban bus companies Howick and Eastern Buses, the Wellington-based bus service Mana Coach Services and Waiheke Bus Company, as well as the Auckland Fullers Group Ferries and the 360 Discovery Cruises. ManaBus.com said the combined entities will transport more than 13 million customers a year and employ 670 people. At the launch of ManaBus.com, Sata said his company had invested $100 million in its New Zealand bus and ferry services over the past 7 years. That included a $5 million investment in the 6-bus fleet for ManaBus.com. In February, Salter Investments invested $12 million in 15 new double-decker buses for Auckland to double its load on the city's most congested routes.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
I'm Grant Walker with Heads Up. Here's what's trending on NBR Online. Transport Minister bashes Auckland. The Reserve Bank is about to. Reaction to the new Quake rules. TVNZ wants out of some election coverage obligations, saying they don't rate. And a short honeymoon for MYOB. If you're travelling today, Auckland fine-ish. Wet and windy in Wellington, Christchurch, cloudy and windy, and cloudy in Dunedin. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. To the courts. Despite the weight of documents piled upon the bench at court number 3 at the Auckland High Court on Friday, the object in dispute wafted before the combatants like a will-o'-the-wisp amid the dust of bankrupt Evan Reid's last venture. Barrister Bob Hucker quoted Shakespeare, like the famous line from King Lear, he intoned, "Nothing comes from nothing, speak again." Representing Time3 Global, a company part-owned by interests associated with Mr Reid, Mr Hucker swayed from foot to foot as he leafed through bound volumes of evidence left and right. His job was to confound a avoidable transaction claim brought under Section 292 of the Companies Act by genial liquidator Mark Norrie on behalf of Pakiri Investments, a failed Reid company which had attracted investors with grandiose but vague plans to develop and market an internet operating system. According to Mr Norrie, who was representing himself in court, intellectual property pertaining to the system had been transferred to Time3 Global when it shouldn't have been. Mr Hucker aimed to hit it out of the park with a straightforward point. There had been no transaction, so there was nothing to void. He told Associate Judge Tony Christensen it's a question of conveyance and fact that there is no transfer of property from Pakiri to Time3 Global. If so, the liquidator cannot use Section 292 of the voidable transaction regime. There is simply no transaction. There has been no property conveyed. He cited evidence from a patent lawyer that patents could not be transferred other than in writing, and there was no document showing that the property had been assigned to any other party. He also argued that whatever Pakiri had, it was more in the nature of a license to market intellectual property owned by the Reid Family Trust, which was revoked when Pakiri went into liquidation. The judge was curious on this point. He asked, why would you want to invest in the company if it was in control of a single person to say, well, I'm going to take the asset back now? Mr Hucker said the power was limited to the extent of the funds advanced. Mr Norrie said there clearly had been a transaction since documents referred to the terms of Time3's use of the system, and Reid himself had told Pakiri investors that the property would be transferred. Mr Norrie said as to its worth, value is very much in the eye of the beholder. A loan agreement between Pakiri and the Reid Family Trust talked about it being worth $100 million. The judge said, but the value is clearly not $100 million. Mr Norrie conceded it could be worth a dime. As to exactly where the property was, no one seemed clear, except that it was not in the hands of Mr Norrie as Pakiri's liquidator. Mr Norrie said the system, such as it was, comprised a suite of software code and a user interface. Liquidators had initially been denied access to a building containing the company's computer, and when they obtained access, it was gone. The other main point of argument involved whether there was a creditor relationship established between Pakiri and Time3 Global, with dispute over the nature and origins of $135,500 paid into Pakiri's bank account. Not discussed in court was an attempt by Time3 Global in January to raise $2.8 million US through American crowdfunding website Fundable.com. The move, aiming to finance Time3's operating system for the internet, was stymied when Fundable shut down the fundraising offer over concerns about Mr Reid's continuing bankruptcy. If Mr Norrie is successful in his action, its effect would be to restrain Time3 from further efforts to raise investment money for the product. Mr Reid, who was bankrupted in April 2010 and remains undischarged, is believed to be in Moscow. The judge reserved his decision. To Auckland Housing and the Reserve Bank. The Reserve Bank is expected to signal further financial stability rules aimed at property investors this week. Measures could include restrictions on how much banks can increase their lending to property investors, similar to recent Australian rules, and it also appears some sort of regional targeting of restrictions is under consideration again after having been previously ruled out. The Reserve Bank's biannual financial stability report is to be released on Wednesday morning, and the central bank can be expected to highlight the fact New Zealand's financial liabilities are very much due to bank lending and the property sector. While the talk is of measures to cool down the Auckland property market, the Reserve Bank's primary concern is the overall stability of the financial system over the longer term, not just the ups and downs of the current economic cycle. That important point needs to be remembered amid all the rather loose talk of moves to cool down an overheated Auckland property market. There is no doubt, though, that the Reserve Bank is warming up for some measures aimed at property investors. Although New Zealand's net external liabilities have declined in recent years after blowing out from the end of 2004 until the global financial crisis hit, the improvement has stalled. Wednesday's report will show whether that stall has continued or even whether matters have deteriorated again. The Reserve Bank looks to have dropped one early option, some sort of debt-to-income lending requirement imposed at retail level. More likely are measures mirroring last year's Australian prudential rules. In particular, banks whose portfolio growth to property investors is 10% or more are being subject to tighter capital requirements. Some sort of similar rule here appears on the cards. Deputy Governor Jeff Besand told the Otago Daily Times on the weekend that some sort of regional targeting aimed at Auckland is also in the mix. He was quoted as saying previously, "We'd indicated we think that's quite difficult, but perhaps there may be new ways of it getting a little bit more possible. We're reconsidering that. It's a time of close scrutiny." The Financial Stability Report will be released shortly after 9 a.m. Wednesday morning. To the markets, MYOB's float got off to a flying start, but the question had to be how long the honeymoon would last. The market's answer was swift, not long. Shares in the incumbent accounting software firm in Australia and New Zealand briefly fell below their issue price in their first week of trading. The issue price for its shares was set near the top of the indicative range at Australian 365. Nearly the maximum amount aimed for was raised, 833 million Australian dollars, and the shares debuted on the ASX at a healthy 7% premium. But the prospectus did raise a number of red flags, and it was no surprise a number of Australian fund managers were quoted publicly as being sceptical about whether MYOB was worth the asking price. MYOB says 65% of the new shares were sold to Australian investors, but offshore investors most likely boosted the outcome, viewing MYOB as relatively cheap at just over 23 times earnings compared to about 39 times for US-based giant Intuit's shares. A few salutary facts. At the issue price, MYOB was valued at 2.13 billion Australian. The majority owner, Bain Capital, paid 1.2 billion for MYOB in August 2011, according to Reuters. And it bought the company from another private equity firm, Archer Capital, which paid about 450 million Australian in 2008. The fact that two private equity firms have owned MYOB in quick succession is a bad sign in itself, suggesting MYOB has been wrung dry of potential upside. This was a business drowning in debt. Losses in the last 3 calendar years totaled nearly 180 million Australian, and it had just 91 million Australian of equity left on its balance sheet at the end of last year. And that was all down to the debt burden, which totaled 1.35 billion Australian at the end of last year. Last year's near 140 million interest bill swamped the 40 million in earnings before interest and tax. Interestingly, the pro forma post-float balance sheet shows slightly less equity than the float proceeds, and Bain still owns 58% of that.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
To our film industry, US trade publication Variety reports New Zealand film What We Do in the Shadows did healthy business during its first week online. The low-budget vampire mockumentary was filmed in Wellington and written and directed by Jermaine Clement and Taika Waititi. According to Box Office Mojo, it saw cinema release last year grossing $3.3 million US in the US and $6.1 million US worldwide. Variety says online it's setting the pace on two fronts. First, its US distributor is being open about on-demand revenue. Second, at almost $463,000 US, that revenue is healthy for an independent release. Variety notes since getting released on-demand and digitally on May the 5th, Shadows has been iTunes' most popular comedy and horror film, its second biggest indie title and the sixth top rented and sold movie among all releases, putting it in the company of 50 Shades of Grey and American Sniper. The trade publication says it benefited from being named the indie spotlighted title this month across Time Warner Cable, raising its visibility among cable subscribers. The film is renting for US $5 on average and selling for $13 on average, with a third of all revenue coming from electronic purchases. Variety says Jermaine Clement's active Twitter presence has been a factor in Shadow's success. With limited figures available, it's hard to say who's been the champ for streaming video on-demand sales, but Sony Pictures The Interview is notable for generating US $15 million in online sales in its first week on the back of the Korean hacker controversy that kept it out of many theatres. The Seth Rogen flick has now generated more than US $31 million from online sales, far eclipsing its miserable $5 million box office. World Week ahead. Bets that central bankers will continue to ease monetary policy is likely to help propel global equities still higher this week. China's move, which had been anticipated, isn't expected to be the last time the country's central bank seeks to stoke growth. The People's Bank of China said China's economy is still facing relatively big downward pressure. At the same time, the overall level of domestic prices remains low, and real interest rates are still higher than the historical average, it said. On a positive note, after some disappointing data, the US government on Friday said American companies hired 223,000 workers in April, meeting expectations and easing concerns about the outlook for the world's biggest economy. The unemployment rate slipped to 5.4%, the lowest since May 2008. The data suggests that the Federal Reserve may well delay lifting interest rates until later in the year. Good news for equities, as it bolsters their investment allure. Several Fed policymakers have been making noises about a potential June hike. So on Friday, the Dow Jones Industrial Average rallied 1.5%, the S&P 500 climbed 1.4%, the Nasdaq advanced 1.2%. For the week, the Dow added 0.9%, the S&P 0.4%, and the Nasdaq slipped 0.04%. Investors will eye any clues on rates when San Francisco Fed President John Williams talks about the economic outlook in New York on Tuesday. The significant report this week will be retail sales, given that consumer spending accounts for about 70% of economic activity in the US. But of course, there will be more data to be considered. The NFIB Small Business Optimism Index due Tuesday, retail sales, import and export prices and business inventories Wednesday, weekly jobless claims and the Producer Price Index due Thursday, and the Empire State Manufacturing Survey, industrial production and consumer sentiment due Friday. Last week, Europe's stock 600 rose 1.4%, bolstered by Friday's 2.9% rally. For investors, the key focus will be what happens next for Greece. Eurozone ministers meet in Brussels on Monday in their latest effort to push Athens into a cash for reform accord. On Wednesday, the focus will shift to London, where Bank of England Governor Mark Carney will speak on new growth and inflation forecasts for the UK. To media and politics. TVNZ wants to abandon its obligations to broadcast political parties' opening and closing addresses because they rate so poorly. In a submission to Parliament's Electoral and Justice Select Committee, the state-owned broadcaster says the rules over election broadcasts were introduced in 1989 when it did not have a requirement to behave like a commercial business. Additionally, TVNZ says voters now have access to a variety of resources covering the policies of political parties to choose from, especially through the internet and social media. TVNZ has tried and failed to change the rules in the past. In 2012, it submitted a nearly identical proposal following the 2011 election. The addresses are aired between 7 and 9 p.m, along with restricted advertising. This is prime time, the period with the highest viewing and advertising revenue. The broadcaster says ratings for the addresses in the 2014 election were 38% lower than the average of the 6 previous Saturday evenings. The document says this placed TVNZ at a serious commercial disadvantage to its competitors. If the proposal is rejected, TVNZ wants the election coverage obligations extended to its commercial rivals. It says Parliament TV would be a more appropriate channel to screen the party addresses. TVNZ spokeswoman Lenska Papic says the submission is not an attempt to dilute the broadcaster's election coverage, pointing to Vote Compass, an educational tool developed by political scientists. National Campaign Manager Stephen Joyce told the New Zealand Herald he would be open to the addresses being scrapped, saying they're costly and voters have more options. Labour leader Andrew Little said the submission showed need for a genuine public service channel and that the obligations should remain.
NBR Radio with Hotel de Brit, partying since 1959. www.hoteldebrit.com. NBR Radio.